I think Wall Street has a bit of a secret they do not want you to know about. This is in regards to Jackson Hole. Now, as you are going to see in just a few moments, Jackson Hole tends to historically be a very negative catalyst. It has a long track record of just being really bad, okay? Not even just in recent history, like 2022 or 2023, that did mark the beginning of 10 to 20% corrections. Jackson Hole has always been a negative event for as long as you have been investing or probably have been alive. But there's only been 2 instances that Jackson Hole has actually been positive. And guess what years they were? 1995 and 2007. Both years where Wall Street was convinced that we were going into a soft landing. Specifically, what happened in 1995, I think, holds a lot of historical precedence to where we are today. But yet, Wall Street's not telling you this. I will break down what this means for markets, what could be coming next, and how to best position for this. Because I think, let's be honest, if you look at the S&P on a market cap weighted basis, it's not going to do much. But if you look at other areas of the markets, you could see some huge gains. And I will share with you where I'm investing my money, what I'm doing, and what I'm expecting. First and foremost, again, I want to start with Jackson Hole because on average, you actually tend to have a very negative reaction to the Jackson Hole Economic Symposium. Average performance of negative 1.4% during the speech, and then an average of negative 1.3% the day after. And markets do not tend to do anything. Decline almost 1% until the next Fed meeting. So historically, you don't get much of a positive reaction from Jackson Hole, but there were 2 positive instances. This was 1995 and 2007. Both of these times, Wall Street was pretty convinced of a soft landing. Now, 1995, you basically had a soft landing. 2007, you did not have a soft landing. So it seems like if the markets believe we're going to have a soft landing and we get Jackson Hole, and it's kind of this, we're done speech. This, we've beat inflation. We're going to focus on the dual mandate now. It seems like the markets take these instances positively. And I believe that's why markets did well on Friday. Now, as we did in some of the last videos, taking a look at 1995, it's clear to see that you actually ripped higher after Jackson Hole, like quite a bit. And then you traded sideways following that 10-day rally or so with some volatility, just up and down kind of at these elevated levels. And then you just rallied after about November, right? November, December. You've seen a very strong rally. Even into 2026, you had a very strong rally throughout January and February. So you can actually see that here on chart. This is 1995. This was Jackson Hole, August 31st through September 2nd. This was the Jackson Hole rally. You just traded sideways really after that. You did have some periods of some volatility, but you really just traded at these higher prices following that. And then once you hit really November, it was off to the races. And then you've seen a pretty consistent large rally. You did see a little bit of a fall in December and early January of 96. And then you had a very strong rally throughout January and February for markets. So you ended up going a lot higher from the Jackson Hole speech over the next couple of months. You were actually up 18.5%. Okay. Could that happen again? Perhaps. Again, it's all going to depend on the economic data and what the data is telling us about the economy. If, the soft landing becomes more threatened, if it looks like there's a higher chance of a recession, then obviously stocks are going to do poorly on that. But take a listen to this clip from CNBC. I think it's very fascinating, especially what this first individual says. I think he does have a point.
Paulson and Tim Urbanowitz, excuse me. So, Jim Paulson, do you think that this is a message that's going to sustain the market for a little while? Or are we just going to be kind of going data point to data point and testing the soft landing proposition against what's coming in?
Well, I think it's bigger than just the Fed announcing rate cuts today. I think by doing that, they opened up a lot more positive forces for the stock market that just haven't been there. This is the only bull market in post-war history where the Fed has been tight throughout its entire existence. Normally, the Fed is easing before the bull even starts. So in some ways, I think the Fed in doing this is taking us back to the start of the bull, and they're going to ease rates, which also means bond yields are going to come down for the first time, which also means monetary growth is going to start speeding up even more than it has, really for the first time. And in addition to that, we still have positive real GDP growth. We still have the power of disinflation. And if you put all these together, something we haven't had at all yet, we're going to get a rise in private sector confidence. Consumer and business confidence, I think, is going to start to lift as well, much like the feel of a brand new bull market. And it's all of that together, which normally brings a broad market advance when you start a new bull. And I think that's what we're also seeing. So, yeah, I think it isn't just about the Fed doing 25 or 50. Mm-hmm. It's the intention to ease monetary policy that's opening up a brand new degree of support for stocks that I think is going to persist well into next year.
I mean, if that all comes together, we might be talking about overheating in a frothy market before too long, I guess. Tim.
We could.
Yeah. Tim, on a practical level, how does an investor, I guess, try to navigate this type of scenario or the range of scenarios that might be out there? Because it's going to be hard to get people to look away from the idea that we're still on some level have some late cycle dynamics here as well.
Well, that's exactly it, Mike. And I think what's still important to be focused on is just like there's a lag with interest rate hikes, there's going to be a lagged impact of interest rate cuts as they come through. So investors still need to prepare for a slowdown. Our financial advisors are turning heavily toward buffer strategies, really to hedge volatility as they head into the back half of the year. But we also think it makes a lot of sense right now to focus on pockets of this market where demand is not going to be impacted by a slowdown in economic growth. Think about some of those AI infrastructure names where companies are not going to be pulling back spending there. They should be able to maintain good margins, firm margins. And then when we look at the other side of the house, you look at some of these retail stocks. We really think that's important to focus on stocks. They're actually willing to drop prices to maintain consumer demand. This was a very undercover theme that we saw playing out throughout the Q2 earnings season. You look at a company like Target, where they were dropping prices, demand was very strong, their customers were coming in for a bargain. And then on the other side of the equation, you look at like a Home Depot, where they were trying to keep prices high, they're trying to maintain margins, and the market didn't like that too much. So we think that's really important right now, just given the slowdown that we think is in store for the next 6 to 12 months.
I do want to just add to that, if he's correct, add this in there, that real estate, your home, is most people's largest, asset, okay? Where most of their net worth is in. For years now, people have not been buying homes. They really haven't been able to move in aggregate, right? Because of one, just low supply, you can't find a new house, and then rates being as high as they are. Well, if you start to see people actually selling their homes, buying new homes, the last month's real estate data we've seen was up over 10% month over month for new home sales. If you start to see people able to sell their homes, all of a sudden they're going to wake up with a couple $100,000 in their bank account. Maybe 50 grand, 100 grand, whatever it is. And that's going to be a very stimulative measure to the economy. And, for a while now, I've been thinking about what are upside surprises to the economy? Like where could I be wrong? Where could, some stimulative measures come from in the economy? And it's clear, it's in housing. As long as people are able to sell their homes and they start selling their homes, then they're going to get a lot of money in the bank. And I think that is really one of the biggest upside surprises that we could see that could actually boost the economy quite a bit throughout year end and also deep into 2025 and even 2026. With that said, Dan Niles says Powell's speech today is bullish for risk assets through year end. It is less hedged than expected and leaves the door open for rapid cuts in rates with no use of the word gradual. The important parts of the speech, quote, "My confidence has grown that inflation is on a sustainable path back to 2%. We do not seek or welcome further cooling in labor market conditions. The upside risks to inflation have diminished and the downside risks to employment have increased. The time has come for policy to adjust. The direction of travel is clear." And that's what a lot of Wall Street said, was there was no gradual or, any words that said it's going to be methodical, right? That they're going to go start on a path and they're not going to cut too aggressive. They're not going to cut too slow. It's going to be methodical in nature. There was nothing like that. So that's a little bit of a warning sign to me personally. Like, oh, they think they're going to have to cut more than they previously thought. But at the same time, it's just leaving the door open for larger cuts. It's just not saying anything, right? They can cut slow and methodically, or if they need to, they can cut aggressive if they want to. Dietrich writes on X, "Housing and financial stocks at all-time highs. Listen to who you want to listen to, but listening to Mr. Market tends to be one of the better indicators for those of us who don't have a magic geometric fractal. Do you really think the end is near with that happening?" And that's a good point. Goldman says, "We continue to expect that the August employment report will be stronger than the July report and that the FOMC will deliver a 25 basis point cut in September, but think that a 50 basis point cut would be likely if the employment report is instead soft again." And that's what's going to be important from this point forward is economic data. If economic data comes in good, if labor reports come in good, and there's no, rapid deterioration in the economy, you're going to have a very, bullish market. Okay, stocks are going to do very well and your portfolio is going to love it. I also think you're going to get a more broad-based rally. I do think big tech is probably going to take a back burner here. I do think big tech's probably going to fall from here. But the rest of the markets can do very well. Small caps, value, cyclicals, even materials for that matter, can start to do much better. And I don't think the place to be, the hot place to be on Wall Street is going to be in big tech. Now, if we do see the economy slow down further, then big tech will catch a bid, or, well, everything will kind of sell off. That's also what Nick Timmerhouse says here. While Powell was forceful in laying out the Fed's goals, he offered no specifics about the precise way officials will deliver them to retain maximum discretion. He entirely avoided certain code words like gradual and methodical that some colleagues in recent days had used to describe their expectation for a series of traditional quarter point rate cuts. In doing so, Powell's silence kept the door open to larger cuts if the labor market shows signs of greater weakness in the weeks ahead. Ryan Dietrich says, quote, "We're not seeing any evidence at all that we're near the final stages of a bull market. In fact, we're seeing more and more evidence coming in that this could just be getting started." And this is looking at the S&P small cap 600 with clearly what looks to be a breakout forming. Seth Golden writes on X, "A breath breakout after prior levels saw a brief pullback, propelling stocks above their 20-day moving average to now 90% and the highest year to date. Methinks the market is demanding higher prices." Peter Burskin on X, he is with BCA Research, and they have one of the lowest price targets, I believe, the lowest price target on our markets over the next 12 months. He says a new fiscal cliff. In inflation-adjusted terms, state and local government spending has added 0.45 percentage points of GDP growth over the past 4 quarters, well above the average of 0.16 percentage points over the prior 10 years. State and local governments have increased payrolls by nearly 40,000 per month over this period, 6 times faster than average. Looking out, state and local government spending is likely to slow significantly. According to the National Association of State Budget Officers, state spending is expected to shrink by 6.2% in fiscal 2025 after growing 14.4% in fiscal 2024 and 7.2% in fiscal 2023. The decline in spending reflects sizable one-time expenditures made in 2023 and 2024, which will not be repeated next year. Mark Newton on X says equal-weighted SPX paints a much different picture than IWM or QQQ or SPX, and its recent push to new highs gave doubts about the longevity of any follow-through after yesterday's sell-off via the RSP. While this rally won't extend forever, we still have some work to do in price and time. In case you missed it, Liz Ann Saunders posted this yesterday. All 5 components of S&P Global US PMI weakened in August, increased rates of decline for new orders and inventories accompanied by the first fall in factory production in 7 months. And we now have a new all-time high for S&P 500 forward 12-month EPS, expecting $262.06. This could be a problem area if the economy does slow. We have not seen earnings expectations fall. Even in this 10% correction that we just recently seen, earnings estimates did not come down at all. If you do see growth slow, and earnings estimates do come down, that's where you get large and material downside in markets, like you've seen here in 2022. EPS estimates fell quite a bit, and you got some large downside in markets. Holtzman says Fed rate cuts would facilitate the ECB's ability to further reduce rates. So you could be looking at Europe and really the rest of the world that follows suit with larger rate cuts once we start. This can bring up a question about the yen carry trade and whether or not that is going to get worse and become another issue for markets, but only time will tell. Frank Caparelli on X says SPX upward sloping bullish patterns never work, like joking reference. And you could see that was definitely the case in recent history. And we have another little smiley face here as well, which could signal even higher prices to come. Fed Goolsbee said yesterday, everything we wanted to happen to get rates down has happened. Liz Ann Saunders on X says year-to-date laggers outperformed yesterday, led by REITs, tech, and consumer discretionary were next best performers and continue to be on opposite ends of year-to-date performance spectrum. Small caps outperformed, but are still down month to date. Again, this is another broadening out sign of our markets, and that's clearly what happened on Friday. Small caps outperformed, consumer discretionary, some other areas that have not done well outperformed, and big tech specifically did not do that well. In fact, a lot of your big tech stocks were actually red, like Meta was down 1% on Friday, Microsoft was down 1/3%, Google up less than 1%, Amazon barely positive, Apple was up 1%, but in aggregate, there was a real underperformance of big tech on Friday. And I do think that is a trend that is going to continue. Remember, the reasons why investors have owned big tech over the past 3 years really comes down to 3 things. They're self-financed, so they're not dependent on the interest rate cycle, and consumers do not, get on Facebook dependent on what rates do, right? For an example, and that goes for all of these companies. These companies have a lot of cash, so they're just, getting free interest basically on their money, and that's boosting their bottom line profitability. So as rates have went higher, that has actually helped these companies. And if we're going to go into a recession, theoretically, you'd probably rather be in these companies than real estate or banks or, cyclical companies in nature. So for those 3 reasons, big tech is outperformed. As the Fed starts to cut rates, they get less interest on their cash, right? It doesn't help their businesses, and we presumably have lower odds of a recession. All of these reasons are going to be headwinds for these companies, these big tech names. So I actually wouldn't be surprised if we do see big tech sell off a little bit more and you do see a larger rotation start to occur in markets. Now, again, it's all going to come down to the economic data. If the economic data weakens from here, big tech will catch a bid until it looks like we're going into recession, and then everything will sell off. right? We'll kind of see the same old of what we've seen, big tech leading the markets, everything else kind of lagging behind. If the data gets better and stronger, if the economy looks like it's doing okay, then I will continue to expect big tech to sell off or trade sideways at the very best, and then the rest of the markets to propel higher. It's unclear how much of a positive impact that would have on the S&P on a headline basis. For an example, if all your big tech is down 1% on any given day and the rest of the markets are up 1% on any given day, even though that's a lot more stocks, the weighting of big tech could actually send the S&P down. At the same time, 98% of the markets are actually going higher. So I think the S&P is really not the best measure to look at our markets right now. I think the equal weight S&P is probably where you'd want to be, and the best way to kind of evaluate our markets. And the equal weight S&P hit a new all-time high on Friday, and I do think we're likely to continue to see the internals of the markets improve here. So again, from my perspective, I do think everything else besides big tech really looks attractive here. As long as the economy does not weaken further, as long as the recession fears do not come out in full effect again, I do think high-paying dividend stocks. I do think mid-cap growth. I think value, even materials for that matter, cyclical companies, also small caps, can do well in this market environment, okay? As long as the recession fears are not building, as long as the economic data is not getting worse. But I think it's far too early to say if we're going to have a recession or not. And I think anyone that declares victory on a soft landing, avoiding a recession is full of shit, okay? We're not going to know if we're actually going to have a soft landing likely for like the next year. So economic data is going to be the main story of markets for a very long time. And as the Fed does start to actually cut rates, there is historical precedence of stocks selling off, but I don't think that has to happen because just the Fed is cutting rates, right? I think it's all going to come down to the economic data. I don't think the Fed really matters here. Believe it or not. I don't think the election matters all too much for markets, believe it or not. Yeah, I think there will be some kind of correction or volatility at some point for the election. Usually that happens in September, October. That's a possibility. But as far as large downside for markets, I don't think any of that matters, okay? Or upside for that matter. I just don't think that matters. I think it all comes down to the economic data. And I do think right now, even if you're super bullish, you want to have as much cash on the sidelines as possible. Because if you're wrong and you're super bullish and you're all in on markets, the fall could be painful if we do go into a recession, especially at these prices with, expectations for S&P EPS that are just sky high. There could be a large reset in expectations if we do go through that, recession. If it does start to look like we're going into recession, I wouldn't expect the downside is going to be pretty. You could be looking at 40, 50+% downside if we actually did go into a recession. Okay, because again, the Fed's not going to just come to the rescue all at once like they did during COVID. The government's not going to come to the rescue all at once like they did during COVID. If they do, then maybe we have another round of inflationary pressures that also could come back. I think that could create just a bad problem for a long time. So from that standpoint, I do think you probably want to be a little defensive here. You probably want to have some cash on the sidelines. But you also don't want to miss out on this market either. That's why I do like small caps and value and dividend names that are trading at 5-10-year lows, that have stable dividends, that are just beaten down because everyone has wanted to own big tech. Same's true again for small caps. A stock like a Tesla could make sense in this environment. And, that's where I would want to be invested. if I'm in the markets, right? That's where I'm invested currently in our markets. But I do have a lot of cash on the sidelines to take advantage of buying opportunities as well. So let me know what you think about this information down below in the comments section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.